Johnathan, give me your sense of what you would tell other CEOs who find themselves with an activist investor such as Elliott in their stock, reflecting on what you went through. What would your advice be?
It's funny because we just had your CEO of the stock exchange. I wonder why there are so few publicly traded stocks and why people aren't using that as a liquidity tool. And you know, you gotta acknowledge that the kind of cynicism and beatdowns that we've witnessed probably hurt the number of stocks. There are half as many stocks on the NASDAQ today as there were when I took Athena public not that long ago, 10 years ago. You know, you look at what happened to me. Athena was, since IPO, an average about 23% annual return. Now, for nothing, Elliott was 13 over the same period. No offense, guys, don't sue me. You know, if a 23% annualized return is not enough because they have periods of, you know, a 2-year period where things are going to be bumpy when you retool, when the administration changes, when your regulatory environment changes, it just makes it appealing to stay away. I'm hoping that that we figure out how to get excited again and get companies out again, because I think it's a wonderful feeling, as she said, to make the equity gains available to a broader circle of people than a few PE funds.
Right.
It's part of the reward.
Specific to your own experience with Elliott, initially when they came into the stock, a significant holder, of course, you did meet with them. You certainly seemed to acquiesce to a couple of things in terms of making some cuts and trying to sort of right-size the cost structure.
Right.
Was that the right move, or do you regret having done that at all? Should you have just come back and try to punch them in the nose?
My experience is running a company with a gun to your head is no way to run a company. Better to just say pull the trigger. So the damage to the company culture during that 1-year period, the damage to the optimism, to employee retention, to our ability to hire technology executives was so profound, and the damage to, you know, my family, my friendships, not that anybody was mean, but just everybody was afraid all the time. People would say, we better talk in person, as if the phone was, I'm sure nobody's bugging phones, but that was the tone and tenor of a company that was otherwise wildly, as you can, you know, check your files, we were a very candid, honest, open company, and that attracted people. It attracted customers and executives from places that were more defensive in their posture. And the death of optimism at Athena made it a hard place to run, made it a hard place to sell, and that was really exclusively due to that experience. It was not a cynical, negative, fearful place before. It turned on a dime.
But there was, I mean, you know, Elliott initially had offered $160 a share to acquire this company.
Throw that on your cynicism pile.
But then came in and did due diligence, and many people say that, in fact, they found a company that had not been executing appropriately or properly, and that there were a lot more deeper problems, many of which they point to you as being responsible for.
Absolutely, and I've been making, you know, mostly mistakes for 21 years, taking the company from $1 a share to 208 to 160, you know, 235, and I could go toe-to-toe them all day long and come up with better mistakes than they could come up with. None of them were related to the fact that this was the market leader with a SaaS business model and a long period of growth that was going through a transition.